The following is a sponsored program paid for by First Alliance Credit Union. Welcome to Good Money Moves, featuring Jenna Taubel from First Alliance Credit Union and Andy Brownell. Here's Andy Brownell on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
It's time for Good Money Moves. I'm Andy Brownell, and as always, I am joined by Jenna Taubel, our financial expert from First Alliance Credit Union. Hi, Jenna.
Good morning.
So, last week we navigated about affording the holidays.
Mm-hmm.
What are we going to explore this week on Good Money Moves?
Yeah, I'm excited about today's topic. We are talking credit scores again. And this is an important topic to keep talking about because they can feel really intimidating to people who don't understand how they work. And so I think once you really understand the basics, they start to feel pretty straightforward, and that can actually make a really big difference in your financial future because you're able to manage them better. So we're going to dive deep into what is a credit score and then just kind of get into some of the nitty-gritty about it.
Okay.
For everybody.
Knowledge is power.
Knowledge is power. Yeah. So I'll just start with the basic definition, right? And we'll go from there. So a credit score is a 3-digit number that represents how reliable you are as a borrower to a financial institution that you're looking to borrow money from. So it's like a financial snapshot that lenders use to decide how, risky it would be if they lend you money. So scores typically range from 300 at the lowest end up to like 850 at the high end. With those higher scores then indicating better creditworthiness or less risk for that lender to borrow you the money you're looking for.
Okay. The numbers seem kind of arbitrary. Why isn't it 1 to 1,000 or,
Yeah. They do feel a little arbitrary. I would agree with that sentiment. But regardless of how arbitrary those ranges are, because let's be real, they are made up by the credit bureaus. For whatever reason, they chose these numbers to indicate that. They could have chosen 1 through 10 for all we know, but they chose 300 to 850.
300 is supposed to make you feel good somehow, rather than, you're a 1.
Oh, yeah, maybe.
At least I have 300.
Maybe. Yeah, but the important thing, though, to know is that these numbers do impact your financial life, and a good credit score can make it easier to buy a home, finance a car, rent an apartment, and it can also influence directly the interest rate and the terms you get when you borrow money. So the better credit score that you have, you essentially look less risky to lenders, and that then gets you better interest rates, better terms for the money that you're borrowing, and that saves you so much money in the long run, having a good credit score. So it's important to understand this.
And you mentioned, renting an apartment. It can also influence getting insurance.
Yes.
All sorts of aspects that you wouldn't think of necessarily.
100%.
Okay. So that leads to the big question, I guess. What goes into determining my credit score?
There are 5 main factors that make up your credit score. And these factors are based off of the information that comes out of your credit report. So there's 2 things, your credit score and your credit report. And we can talk more about those in a minute. But the main factors that are used to determine your credit worthiness, if you will, is first and foremost payment history. That makes up 35% of your score. This is the biggest factor in your credit score, and it reflects whether you've made your payments on time or had late payments, whether you've got accounts in collections or there's bankruptcies. That's the kind of stuff that's reflected in this payment history portion. There's also credit utilization. That makes up about 30% of your score. And this measures how much of your available credit that you're using. And so keeping your utilization rate low shows lenders that you're not overextending yourself financially.
Yeah.
The other factor length of credit history makes up about 15% of your score. So that just means that the longer you've had credit accounts open, the better, because it shows there's a level of stability and experience with managing credit. So somebody who only's had credit for 6 months may not have as good a credit score as somebody who's had good credit and payment history for 10 years, because you've been able to show that over time, I'm reliable. There's two other factors that both make up the remaining 20%. So 10%, it goes into the types of credit that you have. So the mix of credit of, installment loans versus credit cards versus mortgages. Having a good mix actually works in your favor because it demonstrates your ability to manage different types of financial obligations over time. And then that remaining 10%, new credit. Every time you apply for a new credit account, it creates what's called a hard inquiry that goes on your credit report. And too many inquiries in a short period of time can actually lower your score. And this is because if you're rapidly applying for credit, that is often an indication that you're struggling financially. So that's where that comes in. So I think focusing in on payment history and credit utilization, those two areas have the biggest impact on your score. These two categories alone make up 65% of your score. So these are really good areas to focus on if you want to improve your credit, is that payment history, making those payments on time every time, and not maxing out your credit cards, essentially, is kind of what that boils down to.
Yeah, you really don't have much control over the length of credit history other than, not having something really bad in your past, but otherwise it's more or less how long you've been on this earth.
Exactly.
Participating in the economy.
100%, yes.
And the one that I think maybe there's the least amount of understanding about is the credit utilization. And I think I've told you the story that it wasn't that long ago, I made a big purchase and put it on a credit card just until the next payment, because it was just the easiest way to do the transaction.
Right.
And it was more than a few $1,000s. That alone, just having that on my card for less than a month, was enough, because of that credit utilization business, to knock my credit score down by 20 points.
Yeah.
I was amazed.
It really does impact your score.
So that is one you really need to track closely.
It is.
Okay. We've discussed what makes up your credit score. What do those credit score ranges, that 300 to 850 number, what does that actually mean?
Yeah, so I'll break it down as simply as I can. So that like 300 to about 579 is what is kind of considered poor credit, meaning you would be a very risky person to lend money to. This is in this kind of range, getting approved for loans is really, really tough. And if you do get approved, there's likely a lot of caveats involved, like they may require you to have a cosigner or have collateral pledged for the loan. And your interest rates are going to be the highest they could possibly be for whatever it is that you're applying for. So not a great place to be.
Okay.
The next tier above that is called fair, and that range is about 580 to 669. You're still seen as pretty high risk, but you will have more options, and those interest rates are going to be a little bit lower in most cases than you would be offered if you were in that poor range. So there's hope. Above that is what's considered a good credit score, and that's between 670 and like 739.
Okay.
So this is where the range most people probably sit in, is about this good range. And this is where you're going to start seeing much better loan terms, significantly lower rates than the fair and poor credit tiers in most cases. So your options really start to open up in this range. But there's still two more tiers that are even better than good. So the next one, very good, that is like 740 to about 799. And this is a really, really good place to be. Most lenders will offer very competitive rates, very competitive terms. You're definitely not going to be asked to have a cosigner. Most of the time, they're going to rubber stamp your application and like move on. But it's going to be quick and easy. Now, the next range is what is like the gold standard of credit scores. And I don't know a lot of people who end up in this range. It does happen. It is possible. And that is 800 to 850. So the world is open to you in the world of credit at 800 plus. You are going to qualify for the best rates and terms available. Lenders, again, are really not going to bat an eye at you at this range unless there's something else going on in your financial life that may be questionable. But this is primo spot to be for credit scores, is at above 800.
And your mailbox will be filled with credit card offers.
It will be filled with personal loan offers, credit offers. People want you to refinance mortgages with them at this credit score. I mean, yeah, you are the gold standard.
Okay. We're talking credit scores today on Good Money Moves. Very important topic for doing that, making good money moves, with Jenna Taubel with First Alliance Credit Union. We'll return in a moment on News Talk 1340, KROC AM, and
Good Money Moves
FM.
continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340, KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340, KROC AM and 96.9 FM.
This is Good Money Moves. Andy Brownell, along with Jenna Taubel with First Alliance Credit Union. The topic today, credit scores. What are they? What they mean to you? And I know, Jenna, we've talked previously about the 3 major credit reporting agencies.
Mm-hmm.
Now, being everything equal, will your scores match on all of these?
Yeah, that's a really good question. And you're right. There are 3 national credit bureaus. There's Equifax, Experian, and TransUnion. And to answer your question, they all calculate scores independently of each other using different scoring models. So it is very likely that you will not have the exact same credit score across each of these bureaus. You might actually see just slightly different variations between lenders, or like even some of the online like credit score tools that you can access. So they shouldn't vary significantly from one another, though. I mean, you should still be within a general same range overall. But you might be, if you're kind of on the edge between, let's say, good and very good, in one bureau you might be a 735. And the other one, you might be a 741, right? And so it can impact you more when you're kind of on that edge between those tiers. So just something to kind of think about. If you're not getting the score ranking and the, offers you want from one lender, maybe go find one that's using a different scoring model and you might get a better outcome. So yeah, they do vary, but hopefully they should pretty much be on track. If they're not, if you find that your credit score is extremely different between different places, it could indicate that one of your bureaus is reporting some erroneous information in your report. It could be that it's reporting old information. There could be that you've got data being pulled in from somebody else because they have a similar name, or something like that, or it could indicate fraud is being picked up on a report that the other 2 aren't seeing for some reason. So it's definitely worth looking into if you do have a significantly different score from one bureau versus the other.
All right. So on a more practical, I guess, platform here, if I'm in that range where I'm below 670,
Mm-hmm.
either because of past mistakes or I'm just young and starting out, what's the best way to move up the ladder and get to that good range or even above?
Yeah, there's a couple different things that you can do to really improve your credit score, whether you need, a fresh start on your credit history or you're, just getting into credit and using it for the first time. If you're a first timer, getting something like a secured credit card is a really good first step. It's just a great starter option because you essentially put down a small deposit of money, which then becomes your credit limit. And it's a lower risk for lenders, but it also helps you build that positive credit history, and you kind of end up with this nice little savings at the end of it all. So we've talked, I think, at length about secured credit cards in previous episodes. So something to look into if that piques your interest. But another
Yeah.
thing you can really do is pay on time. This is going back to what we talked about earlier in the show, that payment history is so crucial. And so paying on time every single time, even if it's just a minimum payment, never miss a due date, because those late payments really stick on your credit report like glue. They really impact you. So that's why that is so important. And then we talked too about credit utilization. So keeping those balances low is actually going to help you out, especially when you're just getting started. Do not max out your credit cards. And if you can, aim to use less than 30% of your available credit on a balance that you're carrying month to month. That's really going to help improve that score too. And then just be monitoring your credit score on a regular basis so you start to understand what your own actions are doing to affect that score. So, and you can go to annualcreditreport.com and check your credit report for free every year so that you can find if you're doing all the right things and your score's not changing, go on to your credit report and look for errors like we talked about earlier as well, because they're not perfect. There's things that can be reflected on those reports that's dragging your score down, unfortunately.
And we've talked about that before. Let's say you have a really common name.
Yeah.
You
Hmm.
know, things can get mixed up.
Yeah. Or if your dad is a senior and you're junior
Yeah.
and you have the same, it does happen. Hmm.
Okay. Great stuff for somebody starting out. What if I'm the person who has some bad stuff in my past, maybe a bankruptcy or something like that?
Mm-hmm. Yeah. So for people who really need more of a fresh start, first of all, just know that rebuilding takes patience and persistence. You're not going to impact those negative moments in your credit history overnight. So, a good way to kind of get restarted using credit is, again, using something like a secured credit card. It works just as well for rebuilding as it does for starting out. Credit builder loans, these are small loans that are really designed to help you build credit as you repay them. Again, kind of similar to those secured cards, but it's an installment loan instead of a open-ended line of credit. Avoid too many hard inquiries. So again, don't go applying for all kinds of new accounts once you're getting kind of back on your feet. Start slow, focus on what you actually need, and focus on being responsible with those funds. And then creating really a positive momentum for yourself, again, is key. It's that payment history component, right? Make sure that you're paying bills like rent and utility on time to help demonstrate that reliability, and really just get in the habit of on time every time, on time every time. That is a huge component to this.
Okay, you said patience and
Yes.
persistence. I guess how much patience? How long will it take if I follow these strategies to rebuild my credit?
Yeah, so you might see your score go up 1 or 2 points a week or two after you start rebuilding your credit. But to really see the impact, you're not going to see anything for a few months, any real results, let's say. And this is because of how fast credit scores change depending on like what those credit bureaus get for information from your creditors, which usually happens once a month. So if you've started making regular payments, it'll probably take a few months for you to see some of those results. And when I say a few months, like 6 months or more.
Okay.
So because remember, credit scores reflect your payment history over time. So in order for that score to see improvement, you have to show consistency over time. So in 6 to 12 months, if you're doing all the right things, you should start to see that reflected in your score over that, again, several months of consistent behavior.
You have to prove yourself.
You have to prove yourself. Yep.
Okay. Credit scores, the topic today on Good Money Moves. We will return in a moment on News Talk 1340, KROC AM, and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340, KROC AM, and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
Welcome back. Good Money Moves. Jenna Taubel with First Alliance Credit Union discussing credit scores, what they are, what makes them up, how you can influence them.
Mm-hmm.
So I guess maybe to be more specific, we've talked about those ranges. What's considered a good credit score if you were looking to do something like, a mortgage for a house or a car loan?
Yeah, good question. So to have the best chance of approval and to qualify for what I would consider favorable mortgage terms specifically, you're going to want a credit score that's in the good or better range, which starts at that 670 level. That being said, different types of mortgages have like various credit requirements. So generally speaking, conventional mortgages, which is most lenders are going to require at least 620. Some for like an FHA loan, these are a little bit more flexible. You might qualify with a score as low as 500 if you can put down at least 10%. Or 580 with a smaller down payment. Again, there's other terms and conditions that go along with these. These are just kind of generalities. Things like VA or USDA loans, they don't have like an official minimum credit score, but generally lenders are going to prefer something of at least 580 or higher. And again, it just kind of situational, right? If you might have a 580 and not get approved, and somebody else with a 580 might, just because they have different other circumstances going on in life. So,
and I imagine a mortgage is a little less risky for the lender because of the asset.
Yes, which is yes. But the length of time on that mortgage tends to be a little bit riskier for some people. So again, there are just lots of factors play into this. But if you don't have perfect credit, you can still get a mortgage. That, I guess, is what I'm trying to get at here.
Actually, I'm a little surprised the numbers you threw out, how low they could be. But I imagine it's a bit different for auto loans.
Yeah. So for auto loans, a credit score of like 670 or higher puts you in a really good position. But even if your score is lower than that, lenders often look at additional factors like your payment history, your debt to income ratio to really determine your eligibility. And again, because to your point about the mortgage, it's a secured loan, you have that security of the auto loan. So there's a little bit more flexibility there. And then of course, lenders like First Alliance Credit Union, we do what we call storybook lending. So if your score is where it is for a certain reason in life that was maybe outside of your control, or you just haven't built your score back up enough, like there's opportunity there for you still. So really, it's definitely possible to buy a house or a car with lower credit scores. But that being said, working towards and having that higher score is actually going to make a huge difference for you in the long run, because those higher credit scores lead to better loan terms, which means lower monthly payments and less money spent on interest coming out of your pocket. So just be thinking, if you are thinking about getting a house and getting a mortgage or getting a new vehicle, even a small improvements in your credit score can make a really big difference. I mean, just think about moving from that fair range to that good range could potentially save you thousands of dollars over the life of that loan because you would get better rates. So better scores, more money in your pocket.
Focus on payments, making sure they're on time, and holding down that utilization rate.
Exactly.
Don't max them out.
Mm-hmm. Exactly.
And from what you've said, I gather that's the key.
That's the key. You got it.
Okay. Great information, Jenna, as always. And I know we've just kind of touched the surface of this thing. I guess point us in a direction where we can find out more if we really want to dive in and understand and learn more about how we can improve our credit scores and take advantage of the benefits of having a higher credit score.
Yes, as always, I encourage our listeners to visit our website, firstalliancecu.com. You can subscribe to our blog. We release new financial tips and advice there regularly. You can listen to past episodes of this show at firstalliancecu.com/podcast or on krocnews.com. You can also subscribe to Good Money Moves on Apple Podcasts, YouTube Music, and Spotify. And as always, I encourage you to reach out to our team at First Alliance Credit Union. We are here to help you start making good money moves today.
That is First Alliance Credit Union, federally insured by NCUA and an equal housing lender. This is Good Money Moves. Thank you, Jenna.
Thanks.
I look forward to chatting again next week.
Yes.
Right here at News Talk 1340 KROC AM at 96.9 FM.